Break-even analysis is a crucial tool for businesses, helping them understand at what point their revenue will cover all their costs, allowing them to neither make a profit nor a loss. Before diving into break-even analysis, it's essential to recap some basic financial terms. Revenue refers to the total income a business earns from selling its products or services. Costs are the expenses incurred to produce and sell these goods or services. Profit occurs when revenue exceeds costs, while a loss happens when costs surpass revenue. In business, costs are divided into two categories: fixed and variable. Fixed costs are expenses that remain constant regardless of how much a business produces or sells. Examples include rent, salaries, and insurance. These costs must be paid even if the business isn't selling anything. On the other hand, variable costs fluctuate based on production levels. For instance, raw materials, packaging, and direct labor costs increase as more products are made. Total costs are the sum of fixed and variable costs. The break-even point is the level of output or sales where a business covers all its costs, meaning it neither makes a profit nor incurs a loss. To put it simply, breaking even means that total revenue is equal to total costs. For example, if a small cafe has fixed costs of £1,000 per month and variable costs of £2 for every coffee sold, it must generate enough revenue to cover both fixed and variable costs before it starts making a profit. If each coffee is sold for £5, the cafe must sell enough coffees to cover these costs. The break-even point tells the cafe owner how many coffees must be sold to reach this level. To calculate the break-even point, businesses use the formula: break-even point equals fixed costs divided by selling price per unit, variable cost per unit. In this example, if the cafe's fixed costs are £1,000, the selling price of each coffee is £5, and the variable cost per coffee is £2, the break-even point would be: break-even point equals £1,000 divided by 5 to £2 equals 334 coffees. This means the cafe must sell 334 coffees each month to cover its costs. Every coffee sold beyond this point contributes to profit. An important concept closely related to break-even analysis is the margin of safety. This represents the difference between the actual level of sales and the break-even level of sales. It shows how much sales can drop before the business starts incurring losses. For example, if the cafe sells 500 coffees in a month and its break-even point is 334, the margin of safety is 166 coffees. This provides a buffer, giving the business some security if sales decrease. Break-even analysis has several advantages. One of the main benefits is that it provides a clear target for businesses, showing them how many products they need to sell to cover their costs. This can be especially useful for startups or businesses launching new products. Break-even analysis also helps in decision-making. For instance, if a business is considering changing its pricing strategy or introducing a new product line, break-even analysis can show how these decisions will impact the number of units that need to be sold to cover costs. Additionally, it highlights the relationship between fixed and variable costs, helping businesses understand the impact of increasing or decreasing production on their overall costs. However, break-even analysis has some disadvantages. One limitation is that it assumes all costs can be neatly divided into fixed and variable categories, which isn't always the case in reality. Some costs, such as utility bills, may fluctuate depending on usage but still have a fixed element. Another drawback is that break-even analysis assumes that the selling price per unit and variable cost per unit remain constant, which may not reflect real market conditions. Prices can change due to competition, demand, or supplier costs, making the analysis less accurate. Furthermore, break-even analysis doesn't take into account external factors such as economic conditions or consumer behavior, which can influence sales. In summary, break-even analysis is a valuable tool for businesses, providing insights into how much they need to sell to cover their costs and helping with decision-making around pricing, production, and sales targets. It simplifies complex financial data, making it easier for businesses to understand their financial position. However, it has limitations and should be used alongside other financial analysis methods to gain a complete picture of a business's performance.